Welcome, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer, and expect that you will use this to make your own financial decisions. Today is Sunday, May 9th, 2021, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888. Last week, I had a lot of positions come off my portfolio, and I have a lot of buying power open to open a lot of new positions this week. So I thought I'd take some time to go through in this week's episode to touch on the things that I do when I screen for new positions. But before we jump to that, I want to first put a plug out there for our Discord channel. There's a link in the description below, and we do run a free Discord channel where you can hop in, say hello, and ask any kind of questions that you might have, whether or not it's from this episode or anything in the financial world that you are not quite sure about. You can hop in there. You can ask myself a question. We have a couple other traders in there that'd be more than happy to offer some guidance or advice. The other thing that I would like to point out is all of my trades I post publicly on thetagang.com. So you can find me, the link in the description below, but it's thetagang.com/sprocket888. So let's get to this week's content. So last week, a lot of my positions ended up coming off either from hitting my profit targets or hitting my loss limits. And I have quite a bit of buying power that's getting freed up for this upcoming trading week. And I thought I'd take this opportunity to go through some of the screening mechanisms that I look at when I go to put on a new trade. And I kind of boiled them down to the basics that I'm looking at. And I put them in order of importance to me. And keep in mind that this is all rough guidelines and nothing is really an absolute metric when I'm kind of screening. So sometimes you'll find that, a certain position might not meet all my criteria, but due to the way that I'm looking at it or something like that, I might still end up putting it on. So let's take a look at the criteria that I have every week. So right here, I have this bullet points put up, and the most important ones I have listed at the top. And then the further down the list we go, the least important they are to me. However, they all are important, and I do look at all of them. And I would say that a lot of these are subjective, and nothing is concrete except for the very first one. Liquidity, liquidity, liquidity. If you don't have liquidity, there is no point in trading. Liquidity gives you the ability to get into a trade easily. It also means that there's going to be the ability to get out of the trade easily. If you are entering a position that is not liquid, you run the risk of not only getting a bad price on your entry, but you run the risk of getting stuck in that position or getting a really bad price when you try to exit. Therefore, I will absolutely not trade anything that is illiquid. And there's a couple of different ways that I kind of judge liquidity, and we'll kind of touch on some of them when we get to the screening and the filter. But I would say the most easiest to do is look at the bid-ask spread of whatever it is you're trading, whether or not that is an equity, an option, or any of that. You want a very tight bid-ask spread. And that is basically just the difference between the buyers and the sellers out there. What price are people willing to buy at, and what price are people willing to sell at? The farther apart they are, it means the more disagreement that they have and the less other people that are actually there bidding on these things. So the higher the volume, the higher the liquidity, the tighter the bid-ask ratios are going to be. So that is a super, super critical point. I would say the most important point. The second point on this list is abnormally high volatility. Now, I tend to typically enter trades that are what's known as premium selling. So what I'm doing is I'm selling options, put options, call options. But what I'm doing is basically I am selling them. And if you look at how an option is priced, one of the largest drivers of an option's price is the volatility. And the higher that volatility, the higher the option price is. And I like to see abnormally high volatility. One, because it means my premiums are going to be higher. But two, if it is abnormally high, it likely means that the volatility is stretched or overinflated and is probably going to come back to a more normal volatility level. And as that volatility declines, going back to that normal level, the option price will decrease. So I sell when that option price is high, and I am hoping that the volatility will decrease and that value will come out of the option so that when I go to buy it back to close, I will be able to get it at a much lower price, thus booking the difference in profit of what I sold it for what I bought it back for to close it out. I am also, for the third point here, looking at a good return on risk. Okay. So I'm typically looking for a range of about 20 to 30% return on risk. And the way that I kind of calculate that is how much premium am I collecting when I sell the option divided by the amount of buying power that executing that trade is going to take away from my portfolio. So I like to see this in about a 20 to 30% range. I will trade a little bit lower. Of course, sometimes I will also trade a little bit higher. I look at different delta strikes, but in general, this is the return on risk or return on the buying power, the initial buying power that I'm kind of looking for. And we'll kind of touch on a couple examples as I jump into the screeners after we kind of get through this list. Now, the fourth bullet point that I look at is the price levels of the underlying that I'm selling the option for. And what I'm looking at for here is support and resistance levels on the chart. So if the trade were to start moving against me, I like to see different levels of support and resistance depending on which direction it's moving as potential breakpoints in the trend that might be developing that is not in favor of where I want it to go. So one of the popular ones, for example, will be the 200-day moving average. So if I am selling a put in a particular underlying, I want that underlying to not move much or maybe even rally and go up. And so what I'll kind of look at is I'll look at where's the 200-day moving average in relation to, say, my break-even point on the trade. And anytime I can have my break-even point below that 200-day moving average, I feel a lot more comfortable in the trade. And the reason for that is if that underlying started going south and declining in value, 200-day moving average is often a point of resistance and a place where underlyings might stop their decline and kind of change direction. So I will enter trades where, my break even is above the 200-day moving average. So it's not really an absolute rule that I'm looking for certain levels of support and resistance. But as I always say, it is really important that when you enter a trade that you have an exit plan defined about what might happen, what are some of the things you're thinking might occur, and basically how an underlying reacts to these different price levels that you identify before you enter the trade is an important part in my decision on whether or not to take a particular trade or not. And the last point, which is really not a screening criteria, but it is something that I will always check into whenever I go to enter a particular trade, and that is understand any upcoming binary events. Okay, a binary event is any sort of occurrence with relation to the underlying company that might dramatically affect its price. So the most common binary event is an earnings event. So whenever earnings are around, that underlying will likely move on the earnings news. It is a one-time bit of news and it will drive the stock up or down or potentially nowhere, but you need to be aware of these binary events. Pharmaceuticals are another one that has binary events that are not earnings. They might be trial results from particular trials upcoming. Some products like Apple, they have particular, announcements slated and scheduled. So you're going to want to check to just understand what binary events are upcoming so you can factor that into your thesis on how you think the underlying is going to move. And is that going to help your trade? Is that going to hinder your trade? Or do you think it doesn't make much difference in your particular trade? So what I'd like to do is take you from here into my trading platform. Thinkorswim is the one that I use with TD Ameritrade, and show you some of the filters or the screeners that I basically start with. And then I'll kind of start going through that checklist of items or bullet points that I just called out. So let me pull up my trading portfolio here. And we're going to go up here to the scan criteria. And basically scanning is where I can have different filters up here of different types. What I'm actually going to pull up is what I call my core option filter. And we are going to start with this one. So this filter only has 3 criteria, and these 3 criteria are basically addressing the first 2 bullets that I talked about: liquidity and volatility. So the very first criteria is the stock price. So I am only looking for underlyings that are trading at least $15. Now, sometimes I'll turn this up, but I found that, every once in a while that will miss some very volatile underlying that might be trading in the lower dollar ranges. A lot of times I like to be in underlyings that are around $50 to say $100. They tend to have a little bit more premium in them that is in my comfort zone. However, I will trade down. But what I found is going much below 15 and you're really kind of just dabbling in stuff that if you want to take a shot at it, options probably aren't the best way to go, or at least for me. Much below this, and I'm probably just outright buying the stock or shorting the stock depending on my bias or thesis. So a lot of times the first criteria I have is about $15 when I go to sell premium of the underlying. Now, the next criteria here is the volatility index. And this is not really where it's been historically. This is where is it right now? What's the percent of volatility? And what I found is underlyings that have less than 30% volatility right now typically don't end up meeting that third bullet point criteria of mine of targeting the 20 to 30% profit that I try to get in that third bullet point. So in order to kind of reach that, I have found that starting with volatility around a 30% level is really kind of where I like to start. And the very last bullet that I have here covers the liquidity, sort of. So one thing that I've found is if the underlying stock trades high volume, it is likely that the options will be liquid in that. It's not a guarantee. However, if the underlying is not a high volume, pretty much almost always the options are not liquid. So I basically look through the past 30-day average of the volume, and I am looking for an underlying that has at least 1 million shares traded over a 30-day average. So, this kind of irons out and discards ones that kind of one-hit 5-day wonders where the volume's super high for 3 or 4 days, but then falls back down into a very low level. This basically has to average 1 million shares over the 30-day each day average in volume. And that's it. This is the only criteria that I basically throw up here. And you can see that right now, this is giving me about 552 potential plays. Now, the other part that I talked about was volatility that is relatively high compared to the historic levels. And so one of the first things that I sort by is what's called IV percentile in TD Ameritrade. Your particular broker platform might call this something else. They might call it historical volatility. They might call it IV rank. But basically what this is where is the volatility, typically on a scale of 0 to 100%, relative to the past 1 year time frame. So for example, in one of these, let's take Electronic Arts. So Electronic Arts has their IV percentile at 55.81. And that basically means that in the past year, the volatility has been lower than where it currently is 55% of the time. And what you can kind of do, I'm going to pull up the chart for EA, and I'm going to show you what I'm talking about here on the chart for EA. So here in the chart, down on this lower portion, I have the implied volatility. And this is basically for the past year. And you can see that it's kind of been as high as about, 0.53, and it's been down to about 0.3, and you can see where it has. And most recently you can see from early April to now, it has slowly climbed in volatility, historical volatility. So right where it is now, it is in the 55% range. So it's about in the middle. However, it is likely, you look at the chart and you can see that for this real long chunk of time from February to April, it was running around 0.3% in there. So I will always look first at the trades that are in the higher percentile of IV. And if you come down to something that is much, much lower, let's just take a look at NEO. So NEO is at 1.48 historical volatility. And if we then go look at NEO's chart, you will see that this thing has been declining in volatility for quite some time. So you can see that in NEO's case, potentially, the current volatility is 66.59%. So that is good volatility to get good premium on. But when we put that in the context of how volatile is that with respect to where NEO has been, you can see that it's pretty much as low a volatility as NEO has ever had. So if I was to enter a trade in NEO, it is unlikely that the volatility will get lower, because things always tend to have a mean reversion. And if volatility starts going higher after I sell an option, that option price is going to get more expensive, even though perhaps the underlying price is not moving. Now, let's say this list over here was not 552 deep. So 552 is a pretty nice pool. But let's say that it wasn't that deep, and let's say some of the IV percentiles there weren't very many that were up here in the 40, the 50, the 60% IV percentile. One of the other things that I'll do is I'll do a quick sort by volume, and I'll say, okay, what's the highest volume stuff? What's going on here with highest volume? I can see Peloton, NEO, DraftKings, AMD, and I'll start checking these. Kind of one of the other criteria is if my IV percentile doesn't pull out any trades or enough trades that I'm interested in entering, I'll sort by volume, and I'll look here at the highest volume names. Um, I'll also kind of look at higher dollar amount. So when I'm sorting by volume here, I'm going to gravitate towards Tesla. So Tesla is a 672 underlying. The premium potentially might be more worth it the higher this underlying actually is. I might come down to Roku. Roku is a $317 underlying. So yeah, let's just take a look real quick at Roku and the option chain here for Roku. And we can see that it is a decent spread. And if I go ahead and we start at, say, a 20 delta, you can see that we're basically picking up about, $715 for about $3,500 in risk. That's about a 20% return on risk. So here's an underlying that I might consider playing. Another way that I might go back to that initial screening list is, let's say, I might just sort by current volatility, looking for the most volatile underlyings out there right now. I can see that Marathon Digital Holdings is about 137% volatility right now. So I will hop over to the option chain here and I will take a look at these. The bid-ask spread are good. I might take a look at, say, a 25 delta here, 26 delta, and I can see that this must be very volatile because the margin requirement is basically this in cash, 26 strike at 100 shares. So it's going to take $2,600 in buying power to pick up $2.53. So again, this is going to be under that 20%. So, probably not one of my first choices. Can hop back over to the screening and maybe look for, GameStop. Okay, here, GameStop, the very famous stock this year, but this one is at 130% volatility. It's $160 underlying. I'm going to take a look at the option chain here just to see what might be going on. And you can see plenty of liquidity. It's a little wider than I like to see. But I can look at the 20 delta here. And yeah, you're pulling in 800, but you're risking 12,500 for that. And that is like a 6% return on risk. So yeah, volatility's high, but my return on risk is a little bit too low for me to take this trade. Now, one thing I want to basically call out is once you have this kind of base screener, you can enhance it. You can add things to it. So for example, maybe you want to avoid binary events. So let's say you're looking at selling maybe the 40 days to expiration that's currently out there. So you want to basically manage that thing around, 21 days to go, 14 days to go. So maybe you don't want any earnings announcement in, let's say, the next 30 days. Okay. So you can add to your filter earnings, and you can say, does not have earnings announcement anytime in the next 30 bars. And currently a bar in this field is defined as a day. So 30 days. So you can see this screener originally had 552. And if I rescan with the same criteria, I now knock this down to 357. So now everything that is listed here does not have any earnings in the next 30 days. So it's a little bit cleaner of a list if you didn't want to have any sort of earnings in the plays that you were going after. So going back to the screener, I've tried different experiments, different techniques. Can tell you one of the interesting screeners that I use when I'm looking for kind of play that's ready to go to the upside. So um, it basically has the same initial criteria that we talked about before. You can see, closing price of 15, volatility at least 30%. Average volume is 1 million shares over the past 30 days. Earnings doesn't have earnings in the next day. I can tweak that a little bit. But now we got some moving averages here. And really what I am looking for is I'm using the 50-day moving average, and I'm looking for the underlying to be close to that 50-day moving average. So and it's also above the 200-day moving average. So what this is looking for is, are you at least 7% above the 50-day moving average or down to 1% below? So in that range of basically at, maybe 1% below the 50-day moving average up to 7% above. So what it's trying to look for is underlyings that have come back down close to that 50-day moving average, and it's still above the 200-day. So potentially it's still a bullish trade. And if we see what this yields back, you can see there's about 154 trades. Let's go ahead and take a look at, we'll pull up EA, and hopefully if I take a look at the chart, it will show what I'm talking about. And you can see, yep. So in the chart, you can see that it was trading up here. The yellow line is the 50-day moving average, and you can see that it has recently pulled back, actually went below the 50-day moving average, is now coming back up above the 50-day moving average. And this is potentially in that range where it came down. And ideally, what we would try to do is sell puts when we're reaching, this 50-day moving average or close to it, hoping for that reversal in the stock to kind of continue on a potential bullish move. Now, this is more of a sideways chart, but sometimes you'll get the 200-day moving average to be a much more defined upward movement, and then your 21 and 50-day will kind of decline and bounce, decline and bounce, decline and bounce. Well, in the long term, all going up, 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 up. And this filter mechanism that I kind of called out here is really looking to try to identify stocks that are basically pulling back to some level, and then looking to potentially kind of bounce off that and go higher. So let's take a look at Ross Stores. This is an example of what I was just kind of mentioning here with the underlying trend being relatively bullish. So if I look at the 1-year chart of Ross, I can kind of see this continued upward momentum on the stock. And you can see the price kind of pulling back to the 2150, bouncing up, pulling back, bouncing up, pulling back. And what I would try to do here is identify when we're charging down to one of these moving averages, sell puts basically as we approach that moving average on a down day, hoping for that kind of reversal in the trend going the other way. So let's recap the points that we have gone over when it comes to screening. And that is point number 1, liquidity, liquidity, liquidity. If it is not liquid, do not trade it. The number 1 rule. Point number 2, when trading by selling the option premium, you are looking for abnormally high volatility. We are selling volatility. We are collecting premium on risk. So we want to do that in an environment that is abnormally high, as it is more likely to do a mean reversion and come back down to the mean, thus netting us profit quicker. Good return on risk. So for me, that is typically about a 20 to 30% return on risk at the initial trade entry point. Next point, understand the price levels of the underlying. This is just a quick chart read to see where do you expect to see support, where do you expect to see resistance. This helps in defining your exit plan and your expectations of the trade as time goes on. And remember, don't look at this only through rosy glasses. You need to look at this from a worst case scenario standpoint. If this thing starts going the other way, worst case, where is the first potential slowdown point? If that gets breached, what's the next one? If that gets breached, what's the next one? And understand all those levels to the point of where your bailout price is. Always have a bailout price exit plan. It's great to have a profit target exit plan, but you need a plan in both directions, losing and winning. Understand upcoming binary events. This is not so important for a screener unless you specifically want to avoid binary events. And you can add filters to the screener to basically say, I don't want any upcoming earnings announcements in the next how many days. So those are the important points and kind of the highlights for the screening that I wanted to kind of go over this week. I believe we're going to try to do a follow-up screening next week, potentially looking at how things are screened for other types of plays aside from premium selling. This episode screener was really focused on the premium selling screeners and the criteria that you're looking for there when selling premium. As I mentioned, I have quite a bit of buying power that got freed up in the past trading week, and this week I will be looking to enter a lot of positions, or at least open a bunch of them. I'm probably not going to open them on up days in the market, kind of wait for a down day on the market, because that's really when the premiums will increase a little bit. So, hop in the Discord room. I'll post in there a lot of plays that I might be considering. I'll utilize a lot of the screening plays that we talked about in this particular episode, a lot of those screening techniques to find the trades that I might want to sell this upcoming week to collect some premium on. As always, you can follow my trades on thetagang.com/sprocket888. So after I already enter them, I do post them there. You can follow my results there. You can see all my winners. You can see all my losers. All the trades are an open book. So you see my performance, you see the good, you see the bad. It really gives you kind of holistic view on how this particular technique of trading pans out in the long term. That's about it for this week. I hope everybody has a great trading week, and I hope that you're able to close out many of your trades for winners this week. So have fun, enjoy, and remember, think outside the block.